Okay, I will record this session and inshallah we will share this recording to you. Okay, so we are first of all, we just a brief idea that we are a Legend Education Study Centers. We are based in Dubai. We are having our academy in Bar Dubai. We are registered through the government. Now, our motto of this session is to evaluate the requirement of the corporate tax, which is going to be applicable in Dubai. So the corporate tax is a new one, a new idea in Dubai. They are going to implement this one starting from Jan 2023. And people know that basically, if you are having the closing on 31st December, so your on the closing is 31st December, then this tax will be applicable for the next year. For example, my company is closing at 31st December, and this law is applicable from June 2023. And after that, my closing will come in December. So this law will be applicable on my company from 1st January 2024 to 31st December 2024. And I will submit the return after 9 months. It means that my company will submit the return in September 2025. So this is the way how you will apply this one. Under corporate tax, they said that the corporate tax should be there for everybody has to pay the tax. There are two rates, 0% and 9%. Okay, if you are having the threshold 375,000 less, then you will apply this corporate tax and you have to file return with 0% tax rate. Now, question is that either you have to file the financial statement. Yes, you have to file the financial statements, even though your, I think somebody's mic is on. Can you just silent your mic? Because some burden is coming there. Who is that? Mute. 1 minute, I will mute myself. Okay, now it's okay. So just listen and carefully that if my company, my income, my profit is less than 375,000, then either I have to submit my account to the department. Yes, even though I am not paying any tax, but I have to submit my financial statements. Now the standard saying that, sir, please, अपना camera, just off your camera, please. Nasir Taib, Mr. Nasir Taib, camera off कर दें सर अपनी. Now this is a statement which is coming under FAQ. In FAQ, they are saying that can you just switch off your camera? Mr. Nasir Tahir, you can listen to me? Thank you very much. Okay, so this is the wording which is available in the FAQ. In the FAQ, the standard saying that corporate tax should be accounted for in accordance with the requirement of the financial reporting standards followed for the preparation of the financial statements. So when you have to submit your financial statements, then you have to follow the international accounting standards, IFRS. Okay, so even though you are not paying any tax, but you have to submit your accounts to the corporate department. And that accounts you have to prepare under IFRS, and that accounts you have to audit it. So audited account financial statement you will submit. So every company in the Dubai mainland, even though they are saying if you are in the free zone, your rate is applicable 0%, you have to prepare your financial statements as per international financial reporting standards, IFRS, and then you have to submit that financial to the department. So the importance of the standard is too much. In the coming period, when this law will be applicable, every accountant should have the knowledge of the international financial reporting standards. That's why we have organized this session, that we have to tell you that how can you get the knowledge of the IFRS. IFRS is very much important for the preparation of financial statements. Without IFRS, you cannot prepare your financial statements. There are 41 accounting standards. 16 are IFRS and balance are IAS. So you have to take knowledge of all the standards, which is not so difficult nowadays because we are here. So our academy is providing these services that we are giving the knowledge of the standards in very economical rates. We have planned, we have the plan, we will discuss the plan after the sessions. So without wasting our time, we are going to start first standard. This standards we selected, this is a very much important standards we have selected for this demo class. This standard is name is IAS 12. Because I don't want to waste my time and don't want to waste your time. I just coming on the topic. The topic is understanding of IAS 12. The name is income taxes. So this is the way this standards we will not go in the detail, but we will go in the depth. We will try to deliver you the knowledge. You can understand what the standards is telling you. When I will finish my lecture, inshallah, at that time you will be able to manage it. You will be feel that this standard is very easily we understand. Okay, so I will try to make this standards very easy for you. In this way, we are doing every standards. We have PowerPoint presentations. So this is the first standard which we are going to discuss today. The name is IAS 12 income taxes. What the standard saying you? First of all, you see that there are two type of books of accounts. Number one is my book of accounts. I'm making my accounts, and then in the tax department they are preparing the same books for me. My books showing that profit before tax is 100,000, and in the tax department, because in the tax department corporate tax, what they will do, they will add back some expenses. They will not allow you all the expenses. Okay, so their profit will be different as per your net profit. So you have to show that what profit you are showing in your books and what profit in the books of tax department. Then you will apply the rate that is given 30%, basically it should be 9%. So it is 9% on the profit before tax in the books of tax department. So I will apply here 30% on 150 because 150 is the tax which is appearing in the as per the corporate tax department. Now that tax I will also subtract from my books of accounts. There is a technical fault in this statement. What is a technical fault? That what is the tax rate I'm applying? I'm applying on that taxable profit, and the same figures I'm showing in my books of accounts. If I'm looking here, you see that my profit is in my book is 100,000, and this 45,000 is not 30% of 100,000. This 45,000 is 30% of 150,000. 150,000 is the taxable profit as per the corporate law. In the corporate law, they're saying that we will not allow you the internet expenses more than 50%. So what they will do, they will add back the internet expenses. So it would mean what happened, their profit will shoot up. When their profit will shoot up, they will apply 30% on that profit. And when you will put the same figure in your accounting profit, then it is not matching. So these standards will remove this problem. The standard saying that this is not a good presentations. If somebody will have no figures for tax department, he is only looking your accounting profit. What he will do? He will say that this 45,000 screen is not showing. Somebody complaining that screen is not available. Everybody can see the screen. Can anybody open the mic and tell me you can see the screen?
Yes.
Yes.
Yes. We will show.
Maybe you have some internet problem with you. Other people are looking at the screen. Just I think you have to just log off and log on. Okay. So what you have to do, the standard said that this is not a good presentation because 100,000, 30% is 30,000, but you're showing 45,000. So what you have to do? You have to change the presentations. In what sense? You will do it like this. You say that in your column, you will show that the tax is 30% over 130,000 and prepaid tax 50,000 we are paying in advance. Then outer side, you bring the 45,000. This is the good presentations. So this is the standard. The standard will explain you that how you will present your tax 45,000 so that it can be easily understood by the other parties. Okay, so you can understand this one. So this standard will tell you how you present it. Okay, now we can see here my profit in my books is 100,000, and as per textbook tax code the profit is 150,000 and the difference is 50,000. This is called temporary difference, and this 50,000 at 30% of this 50,000 is 15,000. That is also coming under the head of prepaid tax. So this difference will be removed in the future. So this is called temporary difference. We will discuss this in detail in the next slides. So I just want to give them an idea for the standards. Say what the standard want from you. The standard want to correct your presentation. Now this presentation is very much easily understandable that how you are going for your text requirement. This is just a basic idea what the standard want with you. Now, just try to understand the basic concept of the standard. For example, I have bring a plant and machinery. The plant and machinery is cost to me for 20,000 dirham. In my book, I said that I will depreciate this plant in 4 years. So I will say that 5,000 I will charge depreciation every year. At the end of the 2022, the value becomes 0. Now the tax department said me that I will allow you depreciation, but I will allow you depreciation 50-50 in 2 years. So you can do one thing. You can claim depreciation 10,000 in the first year and 10,000 in the second year. In the next 2 years, 2021 and 2022, I will not allow any depreciation to you because your 20,000 value will be finished. Let's see what's your lagging. Now I think some people are facing problem. They are calling me in the chat room. Some people are not, I think, see the unable to see the screens. So maybe from my side is it okay? I think that other people are not complaining. Some people are complaining only. Okay, anyway. So we are saying that we are taking an example that in example we have taken the plant and machinery, and this plant and machinery in my books of accounts I will say that I will depreciate it by 5,000, 5,000, 5,000 in the 4 year, and after 4th year the value will be 0. But tax department tell me that I will allow you depreciation 20,000, but in 2 years. First year 10,000 and second year 10,000. Now just see that in my books the value of the machine, I will say that this is called carrying amount. So this 20,000, 50,000, 10,000 in my books of accounts, I will show in my books of accounts, I will say that this is a carrying amount. Okay, now in the text, my audio, can anybody tell me that my audio is okay or not? My audio is okay?
Okay, sir, okay.
No, sir, okay.
1 minute. Hello. Okay. I think that maybe Mr. Nasser, you have some problem. Just log out and then log in again. Then it will be okay. Otherwise it will be disturbed. Okay, so we said that in my books of accounts, now just try to take the concept in your mind that there are 2 books of accounts. One book of accounts is for accounting book, that is my book, that is I'm preparing as per the IFRS. Okay, this is my financial statements, and the other is in the books in the record of tax department. The tax department saying that your plant machinery in my books is 20,000, then first year depreciation is 10,000, and the second year I will give you the full depreciation, and third year there is no depreciation. In the value of the assets in the book of tax format, it is called tax base. So this is only the change in name. When I am saying, wait, chalo baat jao. Chalo. Sir, whose mic is on? Just please mute your mic. Other people will be disturbed now. Otherwise, if you will not listen me carefully, you will not able to understand this standard. This is the most difficult standard in 41 standards. If you say that in 41 standard, what is the most difficult standard? This is the most difficult standard. If you will not give the consultations, then you will not able to understand this standard. Don't think that this is this is the easiest standard. This is the most difficult standard in 41 series of IFRS. So just concentrate on the standard. If you will not understand the basics, you will not able to catch the standard. Okay. Now we are saying that we have two books of accounts. One is accounting and one is in the books of tax department. So in my books, I'm saying that when I will close my books, I will prepare the financial statement at the end of 31st December 2019. What I will show plant and machinery 15,000. Okay, in my fixed assets. And the same side in the tax department will say that your plant and machinery in my books of account is 10,000. So that is the carrying amount in the books of tax department. So we name is tax base. So when I will say tax base, it means that the same plant and machinery value in the books of corporate tax in the tax department. So when I say the carrying amount, it means in my books of account. So here every year I have some amount, same plant and machinery. I have one amount in my books and the same amount, different amount is appearing in the tax base. Why? Because they have allowed different depreciation in different years. I will say I will depreciate in 4 years, but tax department said that he will allow depreciation in 2 years. So this is now one difference will generate. This is a temporary difference. You will say that my book showing that 50,000 and tax department book showing is 10,000. This is a difference. This is a temporary difference. This difference will be zero at the end of 2020. We will say the last of the 2020, both books are showing zero balance. So this difference will become equal after some time. That's why we are saying this is a temporary difference. Now, what will the effect due to this temporary difference? This effect will come in my profit and loss account. If I prepare my profit and loss account, I suppose that my profit is 100,000 in 1919. Then what depreciation is allowed? Depreciation in my books allows 5,000, and in the tax department the depreciation allows 10,000. So at the end of the 2019, in my books the profit is 95,000, but in the tax department the profit is 90,000. I want to pay more tax, but tax department said no, I want to take less tax because in my books the your profit is 90,000. So I will say, oh, very good, I save the tax this year. Next year my profit is 85,000, but tax department profit is 80,000 due to difference of depreciation. I'm very happy again. Oh my God, I have to pay less tax now. But from 21 onward, the tax department profit will increase because he will not allow you depreciation. He has allowed you full depreciation the last 2 years. So now my profit is 105,000, but in the books of tax department, the profit is 110,000. They will ask you more tax. So the standard is that first 2 years you are paying less tax as compared to your accounting profit, but in the next 2 years you have to pay more tax as compared to your accounting profit. So this is where, so when I'm sitting at the end of the 2019, I will say this difference, due to this difference in future, I have to pay more tax. So I will say that this difference is a taxable temporary difference. Due to this difference, today I'm paying less tax, but in future I'm going to pay more tax. So I will say that this temporary difference is a taxable temporary difference. So I have to pay more tax in futures last 2 years. So I will say that I have to generate today what is my tax saving. That saving I will not credit to my income, I will credit to deferred tax liability. I will say that my profit, if you say that tax is really 9%, so I will say 9% of 95,000, 8,000 suppose. But as per tax department, they are asking you 7,500. So this 500 is not my income. I will say that expense debit, credit, I will credit deferred tax liability, because in future when I will pay the extra tax, I will adjust again this liability. So this is the concept of deferred tax liabilities. When you will see that today I am saving some tax, but in future the same amount I have to pay, so that amount I will not take in my income, I will take in my liability, and I will name this deferred tax liability. Understand the concept of deferred tax liability, how you generate deferred tax liability. Deferred tax liability will come from that temporary difference, that difference due to which today I'm paying less tax, but in future I have to pay more tax. So today I'm paying less tax, it doesn't mean that this is my income. I will say this saving is my liability, and I will name this deferred tax liability. And the future, when this liability actually I will pay, I will debit the tax deferred tax liability and I will credit the cash. Okay. Now, sometime due to this difference, today I have to pay more tax, and in future I have to pay less tax. In that case, we will say that this is deductible temporary difference. Okay. When I'm paying today less tax and future more tax, this is called taxable temporary difference. But if I'm paying today, I'm paying more tax, in future I will pay less tax as per my books of accounts, that is called deductible temporary difference, and I will generate a deferred tax asset. So this is the way how you calculate the deferred tax asset and deferred tax liability, that is based on your temporary difference. Okay. Now, when you see the definitions in the standard will say that the tax base of an asset, this is my asset, this is plant and machine, I will give the example. So this is the tax base of the asset will be the future economic benefit flow from the asset. That is called tax base of the assets. So if I see that in my books of accounts, I'm saying I have in my books of account, I'm saying plant and machinery. I'm saying plant and machinery at the end of the year 2020, 10,000. So what will be the tax base of this plant and machinery? So the tax base, the definition is that the standard saying, just close your, thank you very much. Just close your audio or video box. Mr. Nathaniel, just close your video. Thank you. It's not closed. Just close both your video. Okay. So this is the definitions given the standards, that the tax base of the asset will be the future economic benefit which flow to the assets. We will discuss in detail in the coming slides. So what is the definition of tax based liability? The standard saying that the tax base of the liability will be the carrying amount minus future economic benefit. So whenever I'm looking at my balance sheets, my balance sheets and assets is coming there. So if somebody asks me, this is the carrying value of assets, this is the carrying value of this in your books, what is the tax base? So I will have to see that what are the future economic benefit available for against this asset. That amount will be the tax base of my assets. Here in this example, we can say that at the end of the 2021, in my books, the value is coming 5,000 and the value in the books of the tax department coming 0. It means that the carrying amount of assets is 5,000 and tax base is 0. So tax base is nothing, just the value of your assets in the books of the tax department. So what is the tax base of the asset and what is the tax base of the liability? The standard giving the idea that when you are going to calculate the tax base of the assets, then you are not going to look the book of the tax department every time that I will go there. Okay, I have my plant machinery. What is the tax base? I have to call my tax department, boss. What is the amount in your books? No, you have to calculate yourself. When somebody asks me that in your books, your vehicle showing 100,000, what is the tax base? So I will say, oh, this vehicle is my assets. So what is the tax base of my assets? The standard saying that the tax base of your asset is equal to the future economic benefit from flow from the assets. So you have to calculate yourself what is the tax base of your assets. I have my liabilities. So I will say, somebody asked me, what is the tax base of your liability? So how you calculate the tax base of your liability? You will say that this is my liability, and this liability is the carrying value of minus future economic benefit. That is the tax base of my liability. Whatever the liability, my receivables, my payables, my payables, my loans, creditors, everything which is coming in the liability side. So every item in the liability side having the tax base. So how you calculate tax base? The standard giving the formula. The standard saying that tax base of liability is equal to carrying over minus future economic benefit. Okay. We see the practical examples. We do some practice. Now, what is the type of differences? So we say that there are two types of differences. Number one is temporary difference, and other than temporary difference, so the permanent difference. So when temporary difference is there, then you will see that you can calculate the deferred tax liability or deferred tax assets. So that is deductible temporary difference or taxable temporary difference. But if the difference is not temporary, then this is out of scope. The standard saying if the difference is permanent, is not temporary, then this standard will not apply. Okay, so just keep in mind that this standard will come in the picture when the difference will be temporary. If the difference is not temporary, then this standard will not apply. When the difference is temporary, then I have to see that what is going to happen in the future. In the future, I have to pay more tax. In the future, I have to recover the tax. I have to pay tax. I have to book liability. I have to recover tax. I have to book assets. Okay, so this standard based on the temporary difference only. If temporary difference is not there, then this standard will not applicable. Now take one example in practical approach. We said that the tax base of the assets is equal to future economic benefit. I put it on the right side so that you can keep in mind that what the standard saying. Standard saying that when you have the asset in your financial statement and you want to calculate the tax base of that assets, that tax base of the assets will be equal to fair value of your future economic benefit. Now I'm taking one practical example. I did one transaction. I make a sale. When I make the sale, what entry I will pass? I will pass the entry receivable debit and sales credit. Simple entry, sale entry. You make sale, my company make the sales and pass the entry, my receivable debit, debtors debit and sale credit. So when I did this transaction in 2021, what happened in next year? I will receive the cash. What entry I will pass? I will say cash debit and receivable, my debtors credit. So this is a very simple entry. We have taken this example and we will apply. We have tried to calculate the tax base. Now, just one thing, keep in mind that this standards IAS 21 is only applicable on balance sheet, is not applicable on the profit and loss figures. This is a balance sheet approach. Okay, so in these transactions, if I pass the first entry, that is debtors debit and sales credit. In this, we can say that at the end of the 2021, when I prepared my balance sheets, what I will do, I will show in the balance sheet my receivables 100,000, my debtors 100,000. That will be my receivables will be in my balance sheet. Okay, now somebody asked me that in 2021 you are showing in the balance sheet account receivables debtors by 1,000. So he asked me, what is the tax base? What is the tax base of this debtor? Tax base means that what is the amount of this debtor appearing in the books of your tax department. I will not call the tax department and I will not ask them what is the tax base of my debtors. I have to calculate myself. I have to apply these standards. This standard will tell me how to calculate. The standard saying that if you want to calculate the tax base of your asset, the formula is tax base of assets is equal to future economic benefit. Now, when I'm preparing the financial statement of 2021, I want to know what is the tax base of my debtors. At the end of that 2021, I prepared my balance sheets. In that balance sheet, I'm showing debtors by 1,000. Now the question is that what is the tax base of my debtors at the end of the year. So what happened? I have to see what is the future economic benefit. Standard saying that you have to calculate the future economic benefit. So what are these future economic benefits for my debtors? Just keep in mind the figures coming in 2021. In the 2021, my balance sheet showing receivables, debtors 100,000, and I want to calculate the tax base of my debtors on 31st December 2021. In my book, carrying amount is 1,000. I have to see the future economic benefit. So there are two things. One is current economic benefit and one is future economic benefit. Either I will take the benefit today or either will take the benefit in future. Suppose I will take the benefit today. What type of benefit you will take today for these debtors? The benefit is that I will book the sale. Out of the book, the sale will go to the profit, and the profit I have to pay the tax. I said I will not pay tax today because I don't have the amount in my pocket. I said tax permit. I will not pay tax this year. I will pay tax in 2022 when I receive the cash. It means that you are taking benefit today. In future, in 2022, when you will actually receive the cash, that time the tax permit will say you, okay, pay me the tax. Understand the concept? Benefit from the debtors. Benefit I'm taking this year. What benefit I'm taking? I'm not paying the tax. I will say tax permit when in future I will receive the cash, I will pay you the tax. So it means that from these debtors, we have the benefit. In future, I don't have any benefit. Understand the concept? So what do you mean that what benefit? Benefit, I have to pay tax. I did the sale, I have to pay tax. This sale will convert into profit, and the profit I have to pay tax. But I said I will not pay tax. In 2021, I said when I actually received the cash, that time I paid the tax. So it means that I am getting the benefit today. I am not getting any benefit in future. So in this case, in this scenario, future economic benefit is 0. So this is the formula given in that IAS 12. IAS 12 saying that the tax base of the asset is equal to future economic benefit. So in this scenario, when I said that I will not take any benefit in future, I will take benefit in current year, which means that future economic benefit is 0. Okay. Now my book showing carrying amount of the debtor is 1,000, and in future no benefit. It means tax base will be 0. You understand the concept now here? This is a practical approach. So when I will say in my books of accounts, 31st December 2021, I am showing debtors 1,000. Somebody asked me, what is the tax base of these debtors? I will say 0. So this is the concept. The standard will explain you that you have to calculate the tax base of asset yourself. You will not call to the tax department what is the value of my data in your books. Definitely in the textbooks, the value will be nil. So you have to calculate yourself. For each assets, I can calculate my tax base. Now, I will change the scenario. I said today I will pay the tax. I did the sale this year. I will receive the cash next year, but I said, okay, I will pay the tax today. No problem. In future, I will not pay the tax because I'm paying today. It means that, yes, I will get future economic benefit. In future, I will get benefit. I'm paying tax today. In this case, what is the carrying amount? Carrying amount definitely in my books, I will show debtors 100,000. And what is the tax base? Tax base is equal to future economic benefit. What benefit I will get? I will get full benefit. I will not pay any tax. So I will say that the benefit is 100. So tax base is also 1,000. Understand? So in this scenario, the same assets where I have benefit some in future, then the value of tax base will be different. So the tax base of the asset will decide what future benefit you are going to get. If I look at the benefit today, in future no benefit, the tax base is 0. If I'm going to pay tax today, I will not pay tax in future. I will get the benefit in future. The tax base is 1,000. Now, I have to move further now. we decided that what is our carrying amount, what is our tax base. Now, what is the deferred taxation? Deferred taxation come in the picture. Now we already said that. Now in my books, the value is 1,000. In the books of tax department, the value is 0. So there's a difference. This is temporary difference. And this difference is because it becomes 0 in the future. So what I will say that, I will say that if the tax rate is 30%, then I will say that 30% of 1,000, that is my deferred tax assets. What happened that in this scenario, what you are going to do, you will say that I'm getting the benefit this year. I'm not paying the tax this year. My books profit will come. I will say 30% tax. I'm not going to pay the tax. So that tax I will not pay. That is not my income. That is my liability. What I will say tax debit and credit deferred tax liability. So this is the way the standard will say you have to pass the entry here. Even though you are not going to pay the tax today, you will going to pay the tax in future, but you have to pay you have to pass the entry here. You will debit your P&L by the tax expense, 300,000. You will say that my P&L profit before tax, tax at the rate of 1,000 into 30%, 300. So this is tax expense will appear in the P&L. You will debit your P&L by 300, and you will credit your liability. Deferred tax liability. You will not credit the income. This is not your income because in future you have to pay the tax. When you receive the cash, you have to pay tax 300 to a department. So what you will do, you will generate one liability here. You pass the entry, P&L debit and deferred tax liability credit. And in future, when you receive the cash, what you will pass? You will pass deferred tax liability debit and cash credit. That time in 2022, you will not hit your P&L. Okay, so this is the concept. Now in the second scenario, when I will not get any benefit, I will pay the tax. In future, I'm not going to pay the tax. So in this scenario, my carrying amount is 1,000 and my tax base is of the 1,000. Now there is no difference. When difference is not there, the standard saying the difference is not there, this standard will not apply. Okay. So everybody clear for this practical example? If somebody having the question, you can ask. Otherwise, I have to move. So this is the way how you calculate the tax base of your assets. I give an example of debtors. You can take anything your vehicles, your plant and machinery, everything which is coming to your asset side. So you have to see what is the future economic benefit. That future economic benefit will be your tax base, and the difference is there. Then that difference you will pay the rate of tax, that is 9%, and then this 9% will be your deferred tax liability. Okay, now we will take one case for liability side. This is the case we will discuss for the asset side. Now we discuss the case for liability side. Okay, first we do some examples here, then we will go to the liability side. So just keep with me, just see the questions, try to understand the questions and please answer me. Then we will see that how much you can understand. So this is the first example coming in front of you. Just read the example, please, and try to answer me. So first I am going to read you this. I have a plant and machinery. I have a machinery. The machinery value is 100. Okay. For tax purpose, depreciation of 30 has already been deducted in the current and prior periods, and the remaining costs will be deductible in future periods. I have a machinery. The machinery is 100, and tax department has allowed me depreciation for 30. Now, either as the depreciation or through a deduction on disposal, revenue generated by using the machine is taxable. Any gain on disposal of the machine will be taxable, and any loss on the disposal will be deductible in the tax purpose. Now the question is that what is the tax base of this machine? Just try to recall my example and then answer this question. Just read the examples yourself, then you will be able to answer. Okay, everybody. You can write in the chat room. Just read the questions and answer what is the tax base of this machine. Yes, anybody can answer?
So, sir, 70?
70. Very good. Very good. The answer is 70. One answer coming 70. Look, what is he saying that? He's saying that the machine value is 100. Okay. And the tax department already allowed you 30. Okay. He will say that in the tax department, he will allow you 100. But he already allow you 30. So in future, what depreciation he will give you? He will give you more when you charge depreciation 70 in the future, the tax department will allow you. So you can say that the tax base of this machine is 70. Very good answer. Now, next question. Just read this question and answer, please. Interest receivables has a carrying amount 100. Interest receivables is carrying amount is 100. The related interest revenue will be taxed on cash basis. The related revenue will be taxed on cash basis. So what will the tax base of interest receivables?
Sir, 0 because we have not received any cash.
Okay, 0. 100. Numan Akhtar saying 100. Look, what is saying that? First is the interest receivable. Interest receivable. So what entity you will pass? Just pass the entity, you will understand. Interest receivable, what is interest receivable? So you will say interest receivable account debit to interest income P&L. I will pass this entity today. What entity I will pass today? I will pass entity interest receivable debit and interest 0. Okay. Current entity I will pass today. Interest receivable debit and P&L account credit. Interest income credit. The tax department said that this income I will show the profit and loss account. My profit will increase. I want to pay tax. But tax department is only that the related revenue will be taxed on cash basis. When you receive the cash, that time you can pay the tax. It means that in future I will receive the cash. When I will receive the cash, I will take cash debit to interest receivable credit, debit credit. So this account will be contact with this amount. And I will receive the cash. When I will receive the cash in future, I have to pay tax. It means that in future I have no economic benefit. But today I have economic benefit. I am not paying to tax today when I will show income in my P&L. But in future, when I receive the cash, I have to pay tax. It means that there is no future economic benefit. It means that the tax base is 0. It's a very good answer. Now, one more question. Just read this one. Trade receivables having the carrying amount 100, the related revenue has already been included in taxable profit tax losses. So what will be the tax base of the trade receivables? Recording on, Amari. We are recording this one. We will share the recording. No problem. I'm recording this one. Recording is on. Not applicable. He's saying that is 12 is not applicable in the third scenario. One answer came. He said that not applicable. I don't know why he's thinking that not applicable. You see, trade receivables having the carrying value of 100. So trade receivable, when entity you will pass today, I will pass the entity today. I will say that account receivable debit. I will say account receivable debit to sale. I pass this entity today. Okay. So it means that I book sale today. I have to pay tax. He's saying that the related revenue was already been included in the taxable profit. It means that tax is already given. When you pay, you have already paid the tax. When you book the sale, you pay the tax. In the future, you will not pay the tax. So when I receive the cash in future, I will not pay the tax. It means that today I am not getting any benefit. I'm paying tax today. When I did the sale, I pay the tax. In future, when I receive the cash, I will not pay the tax. In which that I have future economic benefit 100. Okay. So difference is temporary, difference is there. So in future, I will get the benefit, and the answer is tax basis 100. Okay. So I think that you understand the concept. So how you are going to calculate the tax base of your assets. So for each asset, you have to calculate the tax base, and then you will show the difference in the deferred tax liability or in the deferred tax asset. So this is a basic idea. This is a very simple idea how you calculate the. If you go in the original standards, definitely you will not be able to understand the concept as the writing of the standards. But now after this lecture, you can open the original standards. You will easily understand what the standards is saying you. These examples are coded in the original standard. I've taken from the original standards. So when you will open the original standard, you will easily understand what the standard is saying to you. No, this material, this study material, this live recording, everything will be available in the academy. You have to contact with the academy. The people who are already registered with them, they will send the recording to everybody along with the with this slides. This slides will also will be sent to you, and this recording will also sent to you. But only those people will who will register with the academy, they will send the. I will not send to anybody. Just register with the academy. They will send you. Okay. So you have to call the academy. Number is given in our flyers. So you just contact with the academy. They will share the recording, and plus this slides. The slides will also share with you. Okay. So we understand the concept of how to calculate the tax base of the asset. Now we try to understand the concept how you calculate the tax base of the liability. Okay. Now we will take the same one example. Now first, just listen that what is the standard saying? The standard saying that tax base of the liability is equal to carrying amount. Carrying amount means my book value minus future economic benefit. How you calculate the future economic benefit, we already discussed in detail. Now the formula slightly changed. The formula for the tax base of the liability is equal to carrying amount minus future economic benefit. For tax base, the formula was only future economic benefit. But tax liability, the formula is carrying amount minus carrying amount of the liability, not for the asset. Now we are going to calculate the tax base of the liability. So the carrying amount of the liability, the book value of the liability in my books minus future economic benefit will be the tax base of my liability. Take one example. There are 2 years, same 2 years, 21, 22. I did one transaction in 2021. When I did the transaction, I booked one expenses. I will say this is my expense, but I will pay this expenses next year. So what I will pass expense debit, P&L debit, and accrued expenses credit. Accrued expenses mean liability credit. Okay. So this expenses, this it will go to P&L and it will go to liability. Debit P&L, liability credit. So what happened in future? In future, I will pay cash. So I will reduce my liability and I will pay my cash. This is in the future the entry is there. So these are the transactions which I did. Now due to this transaction, these are liability. There is a liability. When I close my books or 2021, I will show a liability accrued expenses 1,000. Now I want to calculate the tax base of this liability. So now we try to understand how you calculate. Now in the question, in the formula, we can see that the formula is that tax base of liability is equal to carrying amount. I know the carrying amount is 1,000. And I have to see what is the future economic benefit. And I know how you calculate the future economic benefit. What is the benefit? What benefit I will get here? So there are two positions. Either I will take the benefit today or I will take the benefit in future. Now suppose that I will take the benefit today. What the benefit I will take today? I will say that this is my expense. Okay, I will charge in the expense 1,000. The tax department will say that, okay, I will allow you this expense. It means that I'm getting benefit of this expense in current year. So in future, when I will actually pay it, I will say I actually paid the, I will get any deduction from the profit. The tax department will say no. Now in future, you cannot be able to deduct this amount from the profit, because you get the benefit in 2021. In 2022, there is no deductions in the profit. Only in 2021 you get the deduction in profit. What will be your profit, taxable profit minus 1,000, and on the balance amount you have to pay the tax. So it means that I am getting the benefit, tax benefit in 2021. In 2022 there is no future economic benefit. Okay, so what is the carrying amount in my books? It was 1,000. And what is the amount? What is the tax base of the liability? I will say that what is the carrying amount? The carrying amount is 1,000. The formula is this: carrying amount minus future economic benefit. So what is the carrying amount? Carrying amount is 1,000. And what is the future economic benefit? 0. Okay, in future I will got no benefit. It means that what is the answer? The answer is 1,000. Clear? So I will say that by carrying amount 1,000 minus future economic benefit, no future economic benefit. So when no future economic benefit, so answer is 1,000. Okay, Ji. So I can say that the tax base of this liability accrued expenses in 2021 is 1,000. How you calculate? You calculate with the formula given in under IAS 12. The formula is the tax base of liability is equal to carrying amount minus future economic benefit. So I have taken all the benefit in the current year. In the future, when I will actually pay, this expense will be not allowed by the tax department. There is no benefit in future. So I will say the future benefit is 0. Carrying amount minus future benefit. The answer is 1,000. This 1,000 is your tax base of the liability. Okay, clear? Easy mode. Okay. Now we take the next scenario. I will say that I will not take benefit in current year. I will take benefit in future. What benefit in current year? I will say that when I will debit my P&L by 1,000, the tax permit said add back this expense. I will not allow you. I will allow you when you will actually pay it. Okay, just like your pension expenses, your gratuity. Lot of examples are here. The tax permit said I will not allow this year. When you will actually pay it, I will allow. So it means that in current there is no benefit. I will get benefit when I actually paid. When I will actually pay it, I will say that now tax department, can you allow me? He said, okay, you can reduce your profit. So in this scenario, what I will say, what is my carrying amount? My carrying amount is 1,000. What is my tax base? So I will test the tax base. Tax base is equal to carrying amount 1,000 minus benefit. Yes, I will get benefit 1,000 in future. So tax base is 0. So in this case, second scenario, when I will not take the benefit current year, I will take the benefit in future. So what will the tax base? The tax base will be 0. Clear? So this is the way how you calculate the tax base of your liability. Why you are calculating this tax base? Because you want to calculate the deferred tax asset or deferred tax liability. Now, in first scenario, you will see that the carrying amount and tax base is equal. There is no temporary difference. When there is no temporary difference, this standard is not applicable. But next scenario, there is a temporary difference. And this temporary difference, what you will do? You will take benefit in future. So in this case, you will generate one asset. Here, 2021, you will pay tax. You will pay tax. What you will debit? You will debit your tax expense, P&L debit, tax expense debit, and you will credit your cash. You will pay here. But now, actually, basically, you are not debiting your P&L. Your P&L that get benefit in future. So what you will do? You will put here a deferred tax asset in place of P&L, and you will generate one deferred tax assets. For this difference into 33% by taking the tax rate to 9%, you will take 9%. Okay, so you will generate one deferred tax asset in case of liabilities. So this is the main idea how you will calculate the tax base of your liabilities. For all the liabilities appearing in your balance sheets, you need the value of tax base, because on the difference I will apply the rate and I will calculate the deferred tax asset. Okay, now I will test your knowledge. What do you understand from this slide? We will do some examples. Example number 1, please answer. They say the current liabilities include accrued expenses with a carrying amount of 100. The related expense will be deducted for tax purpose on a cash basis. So what will be the tax base of this liability? They say that current liabilities include, in the current liabilities, we are showing accrued expenses. Then I should prepare the balance sheet. In the balance sheet, this is the balance sheet. This is my liability side. In the liability side, we're showing current liabilities. In the current liabilities, I'm showing accrued expenses 100. So what is the tax base of this 100? So some answers are coming there. 0, 0, 0. 0. The answer is 0 coming 0. Why 0? Look, isn't that we are showing this liability? The related expense will be deducted for tax purpose in cash basis. Future 100. One answer is coming 100. Very good. So both answers are there. 0, 0, 3 answers for 0, 1 answer for 100. Okay, let's see the concept. The concept is that today in the balance sheet I'm showing 100. This is the carrying amount. This is called carrying amount. Okay. Now what is the tax base of the liability? The tax base of liability is equal to carrying amount is always there. Carrying amount minus future economic benefit. So I will say the carrying amount is 100. Okay. So what is the future economic benefit? He's saying that the related expense will be deducted for tax purpose on cash basis. Basically, in this year, the tax department will not allow this expense. He will add back the expense. When he actually paid, he will give you the benefit. So it means that in future, I will get the benefit. This is allowed expense when I will pay the cash. So when I will pay the cash, I will say department, now allow me this expense. He will allow this expense and I will have to pay less tax in future. So 100 minus 100 is 0. So tax base of this liability is your 0. So who answer 100? Just review yourself and read the next illustrations. Answer this one. Sir, please show the previous slides to tax-based assets for 1 minute. Tax base of asset. This is a tax base of asset. Boss, not 100. Next one. Okay, this is the tax base of asset. Yeah, I will give the recording. You can see the recording now. Okay, the second answer. Second answer is, one answer is coming 100. The current liabilities include interest revenue received in advance with a carrying amount of 100. The related revenue was taxed on cash basis. So one answer is coming. One answer is 100. Please answer. One answer. One answer is 100. 100, 100, 100. So all people are saying answer. Anybody 0? Nobody 0. It means the answer is entered. Look. What is a year? And there are 2 years. There's 2 years. Okay. So what is the first year? First year, the entry. What is the entry? The current liability code interest revenue received in advance. When you receive advance, you will say cash debit, cash code debit, and interest income credit. Interest income in P&L credit. Okay. So you will credit your P&L with earned income. This is your earned income. You receive the interest in advance. So you will debit the cash and credit earned income in P&L. So it means your P&L will show profit. But tax department said that, what he said that the related interest revenue was taxed on cash basis. So when you receive the cash, he will ask you the tax. He said pay the tax today. Okay, he will say pay me the tax today. In future, no need to pay tax. When you receive, when next year what happened? Next year I will earn this money income. This is advance payment. I received cash in advance. This is not my income. This is earned income. Earned income, it will not go to P&L, it will go to liability. This is earned income. I receive cash in advance. So if I will earn this income next year it will go to P&L. When it will go to P&L, I will not pay tax. Understand the concept? This is earned income. Earned income will not go to P&L. It will go to liability. And next year, I will say liability debit and P&L credit. I will debit liability and I will credit P&L next year. So in this year, when I will credit P&L, I will not pay tax because I already paid the tax when I see the cash. So in future, I will get the benefit. So what the formula? Formula is carrying amount. Carrying amount is 100, and in future I will get full benefit. So amount is nil. Tax base of this liability will be nil. The people answer 100, but my answer is nil. Just tell me, you understand the concept or not? Because everybody is giving the wrong answer. You understand the concept? The concept is that today, when I receive the cash, I will say cash debit and earned income in the liability side credit. This is my liability. But tax department will say that in the P&L, you are not showing profit, but you have to pay my tax today because you receive the cash. So next year, what activity will pass? I will debit my liability and I will credit P&L. So I will increase my profit. I will not pay tax on this profit because profit is already paid. Tax is already paid. So my future economic benefit is 100 and my carrying amount is 100. It means that my tax base of the liability is 0. What point you are not getting that? That is simple point now. You will not getting benefit today. You will get the benefit in the future. You are getting benefit today. You will not get benefit in future. Simple concept. What is the concept here in this illustration? In this illustration, that when I receive the cash, I will get cash debit and liability credit. Okay. Now tax department said me that please pay the tax. It means that today I am paying the tax. In future, I will not pay the tax. So I will get the benefit in future. So future economic benefit, yes, is there. 100 is there. Carrying about 100 minus 100 is 0. So my tax base will be 0. Okay. Just try one more example. I think. Okay. Next example. Just read this one. Please answer this one. Just clear your concept. Please answer this one. Yes, 2 answers coming there. 100, 0, 0, 100, 100. Though mix-up answer is coming there. Somebody saying 0, somebody saying 100. So still, maybe if our answer is 100, then the people are saying 0. They don't have the concept. If answer is 0, the people saying 100, the concept is 0. Okay. Anyway, we will try. We will try to solve this one more time. Now look, what's the question? Question is that the current liability includes accrued expenses with a carrying amount of 100. Okay. So 0. Okay. So this is the case we already did it in the last slide. If you remember the last slide, we take the same example. We have generated expense debit and accrued expenses credit. So this is the same case. Accrued expenses, what entry he passed? He passed the entry expense debit P&L and credit accrued expenses. So P&L is debit, and liability credit, accrued expenses credit. So this is the entry. what is saying that related expense has already been deducted for tax purpose. So you already get the benefit today. In future, no benefit. When you pass the entry P&L debit and liability credit, and the P&L that expense is allowed by the tax department, it means that this year you get the benefit. In future, when you will actually paid, that time you will not get any benefit. You cannot claim the expense. Only one time you can claim the expense. So in future, you want to claim? No. So no benefit in future. So what is the carrying amount? Carrying amount is 100. In future, any benefit? No. In future, no any benefit. I get the benefit in the current year. So the tax base is 100. Okay. Understand? Who answers 0? That answer is wrong. Answer is 100. Why? Because you have claimed your expense in this year. In future, you will not be able to claim your expense. So you will not get any benefit in future. You are getting benefit in current year. So formula is tax base of the liability is equal to carrying amount minus future economic benefit. In this scenario, carrying amount is 100 and future economic benefit is 0. So the answer is 100. The tax base 100. Carrying amount 100. So this standard is not applicable. No deferred tax asset, no deferred tax liability will generate because there is no temporary difference. Okay. So in this case, you will not record any deferred taxation. Okay. So one more question, last question. Please try to answer correctly. This is the last question. Please answer correctly. Just try to understand the concept, because I do very hard work with you, and I want very correct answer for this last question. Just read the questions carefully. Please answer correctly. Don't make a guess. Permanent difference. Permanent difference. Permanent difference means this standard is not applicable. So one answer is coming, that is a permanent difference. This standard is not applicable. One answer come. It says the current liabilities include accrued fines and penalty with carrying amount 100. So he got a fine and penalties. So he said debit entry, P&L debit with and credit your penalty debit, penalty payable credit. So what entry he will pass? He will say permanent difference. Very good. 100 minus 100 0. Okay. Just make his mute now. Why I have to make the mute? Please keep your mics mute. If you want to do any question, then you can open your mic. Otherwise, if I will mute, other people will be disturbed. So kindly mute yourself, your mic. Bilal Rashid, Mr. Bilal Rashid, I am unable to mute your mic. Just might mute your mic yourself. Okay. So the question is that current liabilities include accrued. What entry I will pass? I will pass entry penalty debit, fine debits, and penalty payable credit. Okay. So P&L debit and liability credit. Now, fine and penalties are not deductible for tax purpose. In future, I will not get any benefit. Today, I will not get any benefit. Okay, so it means that this difference will continue forever. Okay, so if I put the formula, I will say that what is the formula? The formula is that carrying amount is 100, and in future any benefit, I will get no benefit in future. The benefit is 0. 100 minus 0 is equal to 100. The tax base will be the 100. If you come with the formula, you can come with the formula, or you will say that is a permanent difference. In permanent difference, the carrying amount and tax base remain same. Okay, or if you want to put the formula, you can put the formula carrying amount 100 minus in future any benefit, no benefit. It means that 0, 100 minus 0 is equal to 100 your tax base. Okay, in both the situation, if you apply the formula, answer will be the same, 100. Okay, so this is the concept. How you calculate the tax base of your liability, how you calculate the tax base of your assets. This standard is basically based on the balance sheet approach. So what you will do under these standards, you will calculate the tax base of each assets. You will take the temporary difference, you will apply the current rate on that temporary difference, and that amount you will book as a deferred tax liability. And then you take the tax base of every item of your liability, and the difference you apply that rate, and you would show the deferred tax asset in your books of account. Okay. This is a balance sheet approach. Now, if I'm saying that I have the assets, my carrying value is higher and my tax base is less, or my carrying value will be lower, my tax will be high. Both can be happened. Either my carrying value is 100, the tax base is 0. So my carrying amount is higher, tax base is 0. Either my carrying value is 0, but tax base is 100. It means my carrying value is less, my tax base is higher. So how you calculate the tax base in this scenario? I gave you the simple idea. Now I will say that just look at this is my tax base. And this is my carrying value. My carrying value, first scenario is my carrying value is higher and my tax base is less. Now you cannot disturb your tax base because this is in the books of tax department. But you can fluctuate your carrying amount. So what I will do, I will bring my carrying value down to equalize with the tax base. So this is the first scenario. First scenario saying that carrying amount is higher, tax base is less. Now what I will do, I will bring my carrying amount to equalize my tax base. So what I will do, when I will reduce the tax base of my assets, my carrying amount of the asset, what I will do, I will depreciate it. What I will pass, I will pass entry depreciation debit asset credit. When I will do asset credit, it means I am reducing my assets, and it will be equal to tax base. Okay. Now when I will reduce my asset, I will charge depreciation debit. This depreciation I will take in P&L. Tax department will allow, he will not allow you. He will allow you depreciation only when your assets and carrying amount and tax base will be equal. When your carrying amount of the asset is higher and the value of tax base is lower, and you will reduce your asset, and the second effect you take in the P&L, in that P&L, that expense will not allowed. When he will not allow you the expense, it means that in future there is no benefit. And when there is no benefit, then you have to generate one deferred tax liabilities, because you are not getting any benefit in future. No benefit, tax base 0. You have the carrying value, and this carrying value you have to pay tax in future because tax base is not there. So you will see that when I will reduce my carrying value to equalize with the tax base, I have to charge something to P&L. I will pass the entry. This is my assets. In my assets in the tax base is here, and in the book is here. So I have to bring my assets. What entry I will pass in my books? I will pass entry P&L debit and asset credit. P&L mean depreciation. So there, that depreciation will not allow by the tax department. Tax department says that I will not allow the value which is higher in your book. So when he will not allow you, then it means that you have to pay tax in future, and you have to generate one deferred tax liability. Understand the concept? When my carrying value will be higher, I have to reduce it, and the difference is not allowable by tax department. So I have to create one deferred tax liability today. I will say my P&L debit and deferred tax liability credit. This entry I will pass today because my carrying amount is higher. But if my carrying amount is lower, then I have to increase my carrying amount, and I will get the benefit. This benefit is your assets. When your carrying amount is less than your tax base, and you will increase your carrying amount to equalize tax base, in this case, you will generate a deferred tax asset. Understand the concept? So this is a naked eye. When I will see my tax base, my carrying amount and my tax base, then I will decide. I have to book the deferred tax asset, or I have to book the deferred tax liability. I will say, where is my carrying amount? If my carrying amount is higher than my tax base, then definitely I have to book deferred tax liability, because in future, when I will reduce the value of my assets, I will charge to P&L. That expense will not allowed by the tax department, and I have to pay more tax in future. So it means that when my carrying amount is higher as compared to my tax base, I have to pay some extra tax in future, and I will generate today. I will generate deferred tax liability. The entry will be tax expense in the P&L debit and credit deferred tax liability. But if my carrying amount is less, my tax base is higher, then I have to increase my assets and I will get the benefit. And in benefit, I will get in future. So I will generate one deferred tax asset in this scenario. Understand? So when you will see that you have calculated your carrying amount, you have calculated your tax base. Now you want to generate deferred tax asset or deferred tax liability. So you have to apply this formula. You will see that my tax base value is here. My carrying amount is upper side. So I have to reduce my carrying value of my assets. When I will reduce the carrying value of my assets, I will credit my assets. I will debit P&L. When I will debit P&L, the tax department will not allow me because your value is already high. So this expense will not allow you. It means that in future you are going to pay more tax. So today I have to generate deferred tax liability for this temporary difference. And when the carrying amount is less as compared to tax base, then what happens? I will get the benefit in future. So I will for this temporary difference, I will generate deferred tax asset. Okay. Understand? Now, in the liability side, it is the opposite side. When you see the liability, the liability side, when the carrying amount is lower than tax base, you will generate a deferred tax liability. And when the carrying amount is higher than tax base, then you will generate the deferred tax assets. Okay. Now, how you calculate the taxation? The formula is there, given that you will take the profit before tax. You will add back the admissible expenses and less the add back the inadmissible expenses less the admissible expenses. That is your taxable profit, and that profit you will pay the tax rate, and you will calculate the current taxation. Now, what you discuss in all these slides, number one, we discuss what is the current income tax, what is the deferred tax liability, and what is the deferred tax assets. So what is the current tax assets? The sense that is the amount of income taxes payable, recoverable in respect of that taxable profit in the current year. That is your current income tax. What is your deferred tax liability? Are the amount of income taxes payable in future periods in respect of your taxable temporary differences. And what is your deferred tax assets? So this is the definitions given the standards we already discussed in detail in the previous slides. Now the standard saying you that there are some disclosure you have to show in your financial statement. This disclosure disclose component of tax expenses. You have to show unrecognized deductible temporary difference, unused tax losses, unused tax credits. You have to change if the tax rate is changed, then you have to show the tax rate is changed due to tax. And when the tax rate will change, your deferred tax asset and deferred tax liability will change. You have to show the temporary differences. You have to show the tax related of item charged directly to the. So these are the summary form. I have taken all the disclosures you have to show in your financial statement with respect to your deferred tax asset and deferred tax liabilities. So this is all about the standards. So what is our motive to do this practice? We have planned to do all the standards in the same way. We have some plan. We will do all this IFRS along with we have some package there. If you want to do IFRS, you can come. We can do only IFRS. If you want to do UA VAT plus corporate tax plus the excise tax, all one package is also there. So different packages are available in our program. If you want to join with us, you can contact with the academy, and they will give you an idea how many courses we are having. Either you want to do separate IFRS courses, we are doing that one. If you want to come physical, we have physical academy in Bartubai. If you want to do online, we have the facility to do online also through Zoom like this. We are doing this one in the same pattern. We will do the online classes. So all is available. You can contact with our academy. The address is there. Please register yourself. The people who are registered with us, we will share this recording with you, and we will share this the slides also with you. And what program you want to join with us, you can join with us. This is a certificate we will provide you when you get the training. This is a certificate given by the KHDA. by the government of Dubai. So this certificate we will provide you when you complete the training with us, so that you have the barcode here. So every time you can put the barcode on your with your mobile, and you from the Dubai government side, you will get your certificate. Your picture will be there. This certificate we will provide you after when you complete the training with us. So now the last sessions, question answer sessions. So if you are having questions, you can open your mics and you can ask the questions. Then I will reply, inshallah. Yes, please. If you have any questions, you can ask questions. You can open your mic and you can ask the questions. Any questions if you want. Yes, please. I'm waiting for your questions. If somebody has the questions with any regards with our IFRS programs, we have our IFRS programs. You want to join, you can just contact with the academy. They will give you the details. We have the physical classes also, as well as we have the online classes. So we are doing this one. Anybody have the questions, you can ask, please. So nobody have the question? I'm waiting for your question. If somebody have the question, you can ask. Okay. So if you're not having the questions, then we have to wind up this session today. Okay. So, okay, one chat room is coming there. You can open your mic and ask. Okay. Thank you very much. So I think that you understand the concept of this IAS 12. So thank you very much. This is basically the basics lectures we have given to you. We want to try to make the things easier for you. So the same way we are doing all the slides. We have all the slides for PowerPoint presentations for all the other standards. We will, when we do the classes, inshallah, we will record the classes and we will also share the recording with you. So if you want to join, you just go to the academy. They will register you, and inshallah we will see you in the class, because these standards are very much important now in the worldwide applicable, especially when you are in Dubai. Then definitely you have to take understanding of the standards. Otherwise, you will not able to prepare your financial statements. And financial statements are very much necessary. Everybody has to submit the financial statement, even though they are paying 0% tax or they are paying 9% tax. So in future, definitely there is a very much importance for the standards. So you have to try, you have to prepare yourself. This is not an easy job. We are giving a lectures for three months. You have to join us for 3 or more than 3 months. This is 50 hours classes. So if you spend some time here, this is your investments. And we are very much easy mode. We were explaining you. We have the classes in Urdu also. We are doing the classes in English also. So just the address is given in the slides. You can see the telephone number here for the academy. So you can WhatsApp them. You can call them, and you can join our classes. And inshallah, we will be glad to see you in our classes. Inshallah, we will try to explain all the standards in the same mode. This is not full-fledged standards. When we will do the classes, regular classes, then we will do the standards in full-fledged. This is just a basic concept. We want to tell you that how we are teaching the in our classes. So this is the, you will see there that we covered 70% of the standards. So 30% still left. Okay. So thank you very much. Thank you for joining. Inshallah, hopefully see you all in the classes. So if somebody has the questions, thank you very much. Thank you very much. Really appreciated for your efforts, for your replies, for your participation. for your timing. Really enjoy. I enjoyed my class. Basically, this class was only for 1 hour, but you people were interested, so I've taken the class long. Thank you very much. Thank you, Naseem. Thank you, Numan. So thank you very much. Thank you. Navis Conrad coming there. Okay, Himal, thank you very much. So, okay.
सर आयशा मैंने भी अटेंड किया सर क्लास
ओके मैं अभी देख रहा था वो शायद पहले आपने नाम
थैंक यू आयशा
ओके थैंक यू आयशा
थैंक यू नुमान को भी
थैंक यू वेरी मच बेसिकली वो अभी मैं देख रहा था तो नाम
so you are one of the best very good class very informative really revives and
thank you very much thank you very much thank you very much thank you very much
God bless you may you prosper day and night in no time amen
inshallah thank you very much so if somebody wants the recording of the I already recorded this one so just contact with the academy they will provide the recording also and we will share the slides also with you okay so thank you very much so inshallah when you will join our regular classes meet you there we have the physical as well as online classes both you can join us okay now I'm going to wind up my classes or my this lectures now thank you very much see you inshallah Allah Hafiz